Let's talk about holding leveraged ETFs for the long term. And before we jump into it, I do have to give the disclosure, I am not a financial advisor and I'm certainly not your financial advisor, so do not take anything that I say as an advocation or recommendation to make an investment. Please do your own due diligence and consider that investing is risky before you make any investment decisions. Now that that's out of the way, let's jump into talking about leveraged ETFs. They're very appealing to many investors, and myself included, because, as I like to say, if you can't beat the market, lever it, right? So you get leveraged exposure, to the market, and the chance of outperforming or underperforming on the downside a market. But because most markets have positive beta, meaning that they go up in time, you've got a pretty, I don't want to say a pretty sure bet, because that kind of, I think, underpins the risk behind levered ETFs, but you've got a pretty confident bet of outperformance over a long period of time. So that brings us to the next topic, which is holding ETFs for long term. And the problem with it here is how the funds actually work. And if we go to SPXL's page, we can see the funds should not be expected to provide 3 times or negative 3 times the return of the benchmark's cumulative return periods for greater than a day. That greater than the day there is kind of the underpinning of the whole ETF, and fundamentally, or not fundamentally, but functionally, what the ETF does is it resets its leverage daily. And there are some products out there that don't reset their leverage daily, but why most of them do reset their leverage daily is because it's basically a safety mechanism. Okay, so if you have a triple leveraged ETF and it goes in the triple leverage, let's just say S&P 500 ETF, SPXL, if the fund goes down 33% and the leverage has not reset, well, then this fund is basically, bankrupt. It's basically going to close. It's basically going to go to zero. So the leveraged ETFs reset their holdings daily because it is very unlikely, and maybe, I don't want to say maybe, but pretty damn close to structurally impossible for the fund itself to go down, or the underlying index, the underlying index S&P 500 to go down 33% in a day. There's certain circuit breakers in the market, and I believe if the market goes down 20% in a day, it closes for the day. Right? So at that point, this fund would get a chance to reset, and then it's going to reset at its current equity value. Therefore, it's reducing the exposure of this thing, or reducing the likelihood that this ETF entirely collapses. So yes, these ETFs re-leverage or reset daily. But now, here's the thing with that daily resetting. That creates decay, because if it's resetting, it's going to be re-leveraging, and ultimately it's not going to get that 3x return. So let's just look at some examples here. And I'm going to show you the flip side of decay as well. If we go to SPXL over a 10-year period here on Morningstar, we can see right here SPXL, $10,000 investment in the S&P 500 would have returned 307.19%. So today it's worth $40,719. The 3x investment in SPXL would have returned 1,983.94%. That's fucking huge. Like, talk about hindsight bias here. I'm like, damn, why don't I just go all SPXL at the moment? But that is hindsight bias. I'm not going to do that. That said, I do have some exposure to SPXL, but we're not going to get into strategy in this video here. Instead, we're going to talk about holding them long term. So anyways, if you held SPXL over this period for a long term, like, damn, you would have done great. Now, you might be noticing like, hey, this is more than 3x that's like 6x. Well, here's the deal. We're talking about 3x on a daily basis. 3x on a daily basis, and trying to get as close to that 3x compound annual growth rate. So if you're 3xing that compound annual growth rate, you're going to have more, and you're positive, you're going to have more than more than just 3x total return of the underlying index. So I guess we'll look at that now real quick here. We'll go to Portfolio Visualizer, and I put this in. I think I went back to the same date, February 2012, February 1, 2012, which is what this would have been here, right? So now we can see on this Portfolio Visualizer chart, and the blue line is SPXL. The yellow line is S&P 500. Yellow line is S&P 500. Red line is emerging markets 3x. We'll talk about that in a second. We're going to come back to that. But when you look at this chart right here, we can see the compound annual growth rate of the S&P 500 was 16.03%. But the S&P 500 3x SPXL did not return 3x that compound annual growth rate, right? 3x this annual growth rate would be about 43%. It did not do that. And then if you were to take a look at the drawdown, notice it more than 3x'd the drawdown. All right, so in this case, this is a strong bull market that we've had for the most part, with the exception of 2018 and then our COVID dip. We've had a nice solid 10, 12-year run at this point. But it more than 3x the drawdown. So you do not get 3x the annual return with that ETF. You do not get, or you get more than that 3x drawdown with it. Not much in this case because it's so strong. We're in such a strong bull market. And that is basically characteristic of the decay. And fundamentally, the way I see it is you're paying for that 3x exposure, right? Like you're not paying interest on it. It's using futures to get that exposure. This ETF is. All of these leveraged ETFs are. There may be some exceptions. They may use some swaps and stuff like that, some other derivatives, but by and large, like 99.9% of levered ETFs are getting leverage using futures, not future trading, but futures markets and futures contracts. So anyways, you're not paying interest, but the way I look at it is, hey, the interest is the decay that you're paying here because this thing is resetting daily. And the downside is, on the drawdown, you are going to have a little bit more than a 3x drawdown, while on the upside, you're going to have a little less than 3x on the upside. Looking at this here, right, it's like, yeah, S&P 500 looks great. Why don't we just 3x the fuck out of everything? Well, let's look at emerging markets here. So I'm going to look at this on Morningstar chart first. And here we can see red line being emerging markets index. I think this is an iShares emerging markets index fund that I put on here. Growth of $10,000 going back to 1109 is basically, what is it? Well, the return is 150.48%. You can see that right here. Total return, or the total value of the return, is going to equal 25,048 at this time. Whereas if you'd invested 3x or invested in 3x emerging markets with the EDC ETF, you're not up 75,000, right? You're down. You're hardly breaking even. In fact, you're not breaking even. You've lost money, and that is because in these sideways markets, when there's no real trend in the market, you're really going to lose a lot to that leveraged decay, that reset every single day. So, yeah, when markets are trending down, it's pretty bad, and I think when markets are trending sideways is really the worst. I guess because when markets are trending down, you've got that potential like upside, like, all right, this thing's going to turn around and swing up. But when these markets, like emerging markets here, just kind of go sideways for a long period of time, and I mean, we can see that here. I mean, it took it from 429.11, it took it, what is that, 6 years to really recover. It was in kind of a 6-year drawdown there, right? So emerging markets over this time period looks horrible with any type of leverage. And that's characteristic of emerging markets going back decades. They kind of go sideways for a while. They don't really trend. They're not a very trendy market. They go sideways and then boom, there's some rapid growth, and they go sideways and then boom, there's some rapid growth in them. So yeah, that's, very important to consider when you're holding ETFs for the long term. Levered ETFs is they decay in these sideways markets that go down. Now, personally, I don't think a decay is kind of the end all of levered ETFs. I don't think it is completely fucking horrible, and here's why. Because number one, as we come back to this chart, remember what I was saying, I look at it as you're basically paying interest on your leverage. That's kind of how I look at it, right? Like there's a cost of borrowing, and in this case, there is no cost of borrowing. So factoring that in, what we're doing is we're basically just going to pay that in the decay. That's one way of looking at it. The other thing too to consider is that during rip-roaring bull markets, you can actually get more than the intended leveraged exposure, right? So check this out right here. This is the S&P 500 index fund and then the SPXL ETF for the year 2020. Rip-roaring great year. S&P 500 on a total return basis up 28.5%. It's fucking great. And then SPXL, look at that, 98.19%. If you're doing the math in your head, that's more than 3x, right? So if we did 28.59 times 3, it's 85.77. So over this year, SPXL actually returned more than 3x. So while you do have that decay risk, when there are strong bull markets, you can get more than the actual 3x exposure. So I'm not saying that leveraged ETFs are risk-free. I'm not saying that they're a good investment. I'm not telling you to put your money in them. Personally, I do have some exposure to leveraged ETFs, and that's based on my own due diligence, my own risk tolerance, etc. My thought is, and how I operate is that, number one, decay is going to happen, and that's really just the cost of borrowing. But number two, with leveraged ETFs, and if you're actively holding leveraged ETFs for the long term, it's very important that you rebalance into an asset that has no correlation, or not no correlation, but low correlation regularly, and more frequently than you would with the rest of your portfolio. So what I do and how I like to do this is with leveraged ETFs that I'm holding for the long term. In my portfolio of leveraged ETFs, I rebalance quarterly. And that way, when one zigs, one zags, and a substantial portion of that leveraged holding is treasuries, long-term treasuries. So that could be represented by TLT. TLT is not leveraged, that's just long-term treasuries index by iShares. And TMF, which is the 3X. Right, so you can see it's down a little bit. Right, and if we were to go forward here into 2020, into 2022, where I'm at, what day is this? This is January 30th, 2022. If we were to fast forward this chart, we would see that SPXL is coming down, and then TMF is going up. So rebalancing frequently, and I'm doing it quarterly, into, or not into, but into and out of with uncorrelated or low correlated assets. And the big uncorrelator from equities is either going to be treasuries, either long-term, 10-year, or cash. Those are really going to get you the lowest correlation to equities. I'm rebalancing frequently so that one spikes, the other one goes down. We can look at here, I'll show you just real quickly 2 periods of this. Look at the last 1 year here, or not 1 year, last year to date. Mind you, that's only 30 days, about a month. Here, right? So you can see while SPXL has gone down, TMF has gone down, a little bit, but not nearly as much. If this trend continues, I'd expect TMF to spike up a little bit. But we can also go and look at the period of COVID. COVID does a really good job of showing its relationship. If we look at March to, let's say March 1, 2020, we'll set this back. Let's go June. We'll go May 31st, 2023, whole months in there. Right, so during this period, you can see SPXL up. Oh, this didn't look like quite what I was looking for. SPXL is up a lot here. Excuse me. Where am I at? All right, March 31st. We need to go back to March 1st. This will get it. At this point, the S&P 500 had started recovering. March 1st. Morningstar chart is not changing. Something keeps botching. Let's go February 1st. There we go. All right. So now we're looking at 2/28/2020 to 5/29/2020. We can see the relationship here, whereas SPXL drops, S&P 500 drops, TLT and TMF, the long treasuries, they spike up, right? So if you're doing this quarterly and rebalancing quarterly, and you rebalanced here on April 1st, you would have gotten into you would have pulled a lot out of TMF back into SPXL, your leveraged S&P 500 holding, right at a time when SPXL was about to rip roar up. So yeah, if you're going to invest in leveraged ETFs, my 2 cents, my own thought on it, rebalance frequently into lowly uncorrelated assets. So guys, on that note, before I sign off here, let me ask, and please put your response in the comments, what do you think about holding leveraged ETFs long term? How are you fitting them into your portfolio? Guys, let me know in the comments below. I'm signing off on this one.